Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video is a bit of a fun one. I would like to go over 10 different companies that are dividend growers. These companies have a growing saved dividends and they have excellent free cash flow to cover that. These are what I would like to call foundational stocks, and there are 10 different companies. Some are overvalued right now, so if you of course interested in any of these companies, just wait until the time comes. Don't just straight away jump in and buy in these companies. And again, this is a bit of entertainment, so always make sure that you do your own research, especially right now where the stock market is all-time highs, everything is going to the moon. Just be mindful, be careful. I will show you exactly the valuations of some of these companies based on Morningstar, and of course you can look at other websites and you can do your own discounted cash flow models and so on, inshallah. But before we do that, as always, I would like you to, of course, join us on the Patreon account if you can. It genuinely helps the channel. You get access to all the dividend trackers, you get access to the watch list, you get access to the ETF trackers, as well as the Sharia compliant and the Discord, where you can actually get access to a lot of brothers who are actually helping each other on a daily basis. Right, let's get started. I don't want to make the video any longer than it needs to be. So as usual, we're focusing on these metrics here. The 5-year average, I'm interested to see how much they grow in that dividend. I'm interested to see if they have a saved dividends, as well as if they can cover that dividends by having a free cash flow. Free cash flow normally is important because that's how the company pays the dividends, of course, pay off any of debt, acquire other businesses to grow their business and so on, pay off any debt. So there's loads of things that they can do free cash flow with. Now let's have a look at the first company, and that is AbbVie. AbbVie is a pharmaceutical company, 315 billion market cap. It has a wide economic moat. Right now the price is $178 per share. It has a dividend yield over almost 3.5%, and the payout ratio is only 54. So normally what we're looking for, anything below 61%, that's what dividend saved and safe dividends it basically considers, okay, being safe. So anything below 60 is absolutely fine. Latest increase was 4.7, so almost 5%, and the 5-year average is actually 9%, which is quite nice. They have been increasing that dividend every single year for 52 years in a row. So there are dividend aristocrats and they're dividend kings. This company is a dividend king because they've increased that dividend for over 50 years. Dividend aristocrats are companies that have increased their dividend 25 years or more. Safety right now, so annual payout is $6.20. Safety 70%, profit margin almost 9%, return on equity almost to 35%, and return on invested capital of 24%. This company has $22 billion right now in the bank that they can use to pay this dividend, increase it by other companies and so on. And remember, a lot of these pharmaceutical companies, they don't grow organically, they actually acquire other businesses. So for example, a new company might come out, doing some sort of a new cancer drugs, whatever, they acquire those businesses to include in as part of their major business as well. So yeah, $22 billion of $1 billion of free cash flow right now, 15% in terms of the total return the last 10 years. Growth estimate next year is 9%. Growth estimate for the next 5 years about 3%. Fairly valued right now, which is quite interesting, but it has gone up basically since I checked this company. But $168 per share is where they think the price should be. Right now is $178, so it's about $10 more than where it should be according to Morningstar. Next company we're looking at right now is Waste Management. This is basically the company that does a lot of collections of basically collected garbage, and of course it does a lot of recycling and so on. $83.6 billion of right now in market cap. Wide economic price right now $208 per share. Dividend yield of 1.44, payout ratio 45%. Latest increase was 7%. 5-year growth rate of 9%. Dividend streak of 20 years of increase in that dividend. So 5 more years and this company will become a dividend aristocrat. Then we have the annual payout, $3 right now. Safety 74%, which is absolutely fine. Profit margin 11%. Return on equity 33%, almost 34%. Return on invested capital of 15%. $1.8 billion of free cash flow. Total return the last 10 years, 19%. This is a company that collects garbage, and this is why sometimes people need to understand you don't necessarily always buy high flying stocks. You can buy this type of companies. And to be honest, I used to own this proper company, and for a while, and then I sold it because it was too expensive. It's never come down since then. So this is one of the company 19% on total return in the last basically 10 years, which is absolutely amazing. Growth estimate next year 10%, then 10% after that every single year. So double digits growth expected in the next 5 years, and 31% premium right now. That's the valuation is the only thing I don't like about this company. $159 per share is where they think the price should be. Right now is over $200 per share. Next company we're looking at today is Procter & Gamble, another company that I own in my portfolio right now. $379 billion of free market cap right now. Wide economic mode. Price right now $161 per share. Dividend yield of 2.34. Payout ratio 58%. And one thing I like about this company is the fact that it's actually growing. That it's been growing this dividend 67 years. And 5-year growth rate of 6%. So latest increase, although it was only 3%, that 6% is absolutely fine, because normally I'm looking for about 6%, 7% and more. Annual payout $3.76. Safety 99%. So when it comes to the safety, perfect. Profit margin 17%, return on equity 31%, 24% in terms of return on invested capital, and $16 billion of free cash flow right now in the bank. Total return in the last 10 years, we're looking at about 9%. Almost 8% growth expected next year. Then 7%, 17% premium right now. $138 per share is where the price should be. But right now is $161 per share. Next one is Home Depot, $370 billion market cap. Wide economic growth, $371 per share right now. Dividend yield over 2%. Payout ratio of 55%. Latest increase was about 7%. Let's call it about 8%. 16% growth in the last 5 years, and dividend streak of 14 years. Now annual payout $9 per share. Safety 87%. Profit margin, return on equity, and return on invested capital, no issues with that. I would have liked the return on invested capital slightly to be double digits or so, but that's absolutely fine. Almost $18 billion of free cash flow right now in the bank, which is quite nice. 18% total return in the last 10 years. Basically, growth estimate next year is 7%. Then after that, 5% in the next 5 years. 41% premium right now. $283 per share is where they think the price should be, but right now we're looking at over 370. So it's a little bit it is quite expensive. Merck is the next one, $328 billion market cap. It has wide economic mode, $129 per share. Dividend yield of 2.38. Payout ratio 192%. So this is coming down. When you look at it, the next couple of years is actually coming down. Latest increase 5.5 billion. The 5-year growth rate of 9%, which is quite nice. Safety is 99%, but they have been increasing that dividend for 12 years, and they will pay you $3.08. Profit margin is actually not great at the moment. Return on equity is about 10%. Return on invested capital about 8%. Free cash flow almost $15 billion. Total return in the last 10 years, we're looking at about 11%. 14% expected to grow the earnings about 14% next year. 62% after that. 14% premium right now. $114 per share is where they think the price should be. The number 6 is ExxonMobil. Is a new addition to my portfolio. $412 billion market cap. Narrow economic mode. Price right now just over $100. Dividend yield of 3.66. Payout ratio only 38%. Latest increase was 4.4%. 5 years is 3%. Growth, basically the dividend streak is 41 years. So they are a dividend aristocrat. $3.80 is what you will get. 80% safety, 10% in terms of profit margin, 18% return on equity, and 18% in terms of return on invested capital. $33 billion of free cash flow right now, and total return in the last 10 years have been 4%. They're expecting the earnings to grow about 10% this year and then decline 10% after that. 16% discounted right now. $129 per share is where they think the price should be. So it is undervalued by about 16% according to Morningstar right now. Next one is Illinois Tool Works, $177.7 billion market cap, narrow economic mode, $260 per share right now. over 2% dividend yield, 56% in terms of payout ratio. Latest increase was about almost 7%. 5-year growth rate of 9%. Dividend streak of 52 years in a row. So they are dividend king. So another king in on this list. Annual payout $5.60. Safety 81%, which is absolutely huge. Profit margin, return on equity, and return on invested capital absolutely amazing. $3 billion of free cash flow right now. They've grown basically that. They've returned about 14% to investors in the last 10 years. Growth estimate next year is 8%, then 4% after that. 23% premium right now. $211 per share is where they think the price should be. And the next company we're looking at today is Automatic Data Processing, which is the company that I own in my portfolio. 105 billion market cap, wide economic mode, $255 per share right now. In terms of dividend yield, to over 2%, which is quite nice. Payout ratio 60%. Latest increase was 12%. 5-year growth rate of 14%. Dividend streak of 49 years. So one more year, this company will become a dividend king. $5.60 is what you will get for every share of this company that you own. Safety 97%, profit margin 19%, return on equity 97%, free return on invested capital of 61%, free cash flow right now $3.3 billion free cash flow. Total return in the last 10 years are over almost 15%. They expected the earnings to grow about 10%, then 11% every year. Fairly valued right now. $240 per share is where the price is right now, should be. And this is one of the companies that I'm actually adding to in the next few weeks before it kind of bounces back. And if we see a pullback, I would definitely be buying more of this company. I genuinely do like the company. Next one is one of the greats when it comes to dividends, J&J, Johnson & Johnson, 390 billion market cap. It has a wide economic mode. Right now, $161 per share. Dividend yield, almost 3%. Payout ratio, only 45%. Latest increase was 5%, over 5%. And the 5-year growth rate of 6%. 61 years of increase in that dividend. So they're definitely a dividend king. $4.76 for every share of this company that you own. Safety, 99%. Profit margin, 15%. Return on equity 18%, return on invested capital of 23%. So absolutely amazing when it comes to profitability side of things. Free cash flow $17.7 billion. Total return in the last 10 years, we're looking at about 8%, 4% next year, 4% after that for the next 5 years. Fairly valued right now, $164 per share is where basically they think the price should be. 161 is where it is at now. And final company is Qualcomm, another company that I own in my portfolio. 173 billion market cap, narrow economic mode, $154 per share right now. Dividend yield is above 2% and payout ratio only 36%. Latest increase was 7%, almost 7%. 5-year growth rate of 5%. In terms of dividend streak, 20 years of increase in that dividend. So 5 more years, this company will become a dividend aristocrat. Annual payout will be $3.20. Safety of 80%, which is absolutely huge. 21% profit margin. Return on equity 37%. Top return on invested capital is 23%, and $10 billion of free cash flow right now. In terms of total return, it was about 9%. Growth estimate next year is about 10% expected. Remember, this is the estimates. This is not accurate, okay? So we're not saying this is exactly what is going to happen. Based on what the analysts have basically said, this is what they think. Growth estimate for the next 5 years, about 8%. Fairly value right now, $140 per share is where they think the price should be. There you have it. You can pause the video and have a quick look. If you're interested in any of these companies, as always, do your own research. I'm going to show you from Sharia compliance side of things. You can pause the video and have a look at it as well. This is based on Zoya. And yeah, absolutely great companies. This is what I like to call foundational stocks. If you, of course, interested in any of these companies, as always, do your research. And if you have not liked the video, please do it, because it takes a lot of time to put these videos together. And I'm absolutely exhausted today. And, you know, inshallah, hopefully, I will be doing a few more videos in the next couple of days. But yeah, let me know if you have any questions. I hope you're enjoying the content. Please, if you can, join us in the Patreon account. Have a wonderful day. Assalamu Alaikum.